Hello everyone, this is Dr. Zabiullah working as Assistant Professor in the Department of Management Studies in Government First Grade College, Gauribidnoor. Welcome to the first session on dividend decision. The objective of this session is to make you understand the concepts of dividend, retained earnings, dividend payout ratio and retention ratio, dividend decision and dividend policy, who takes dividend decisions in a company, and what factors determine the dividend policy of a business. Dividend decision. Dividend decision is one of the most important financial decision to be taken by a finance manager. So in this decision, the finance manager decides how much should be distributed as dividends and how much should be retained for future financing needs of a business. Here, the finance manager decides what proportion of the profits will be paid as dividends to shareholders and what proportion of profits has to be retained in the business for meeting the future financial needs of a business. Dividend decision is a residual decision of a business, and it is also known as the profit allocation decision, where the finance manager allocates the profit across dividend and retained earnings. Dividend policy. In general, policy is nothing but the guidelines. So any guideline in relation to the proportion of dividend and retained earning allocation is dividend policy. A dividend policy is a guideline which decides what proportion of profit should be distributed as dividend to shareholders and what percentage of profits should be retained in the form of retained earnings. So any guidelines in this regard becomes dividend policy. Primarily, the objective of dividend policy is to distribute the profits available in the best manner across dividend and retained earnings, keeping in mind the objective of enhancing the shareholders' wealth. Now let's understand who takes dividend decision in a business. The dividend decision is taken by the board of directors and is then recommended to the shareholders for their final approval at the annual general meeting of a company. The shareholders can reduce the amount of dividend even to zero, but cannot increase the amount of dividend as recommended by the board of directors. If the board of directors do not declare any dividend, the shareholders themselves cannot declare it in the annual general meeting. If the board of directors have arrived at a percentage, let's say 20% is the recommended dividend, the shareholders in the annual general meeting have an option either to reduce the percentage of dividend declared by them or they can make it as zero. So they have two options. One, they can either reduce the percentage of dividend which has been declared to be paid as dividend, or they can make it as zero, but they don't have any right to increase the percentage of dividend. So if the board of directors have not declared any dividend in a year, then the shareholders they have got no right to declare the dividend on. Now let us understand the various factors which influence the dividend policy of a company. These factors are also known as the determinants of dividend policy. Number one, stability of earnings. One of the most important factors which influences the dividend policy of a company is the stability of earnings. Stability means the regularity of earnings. So when the earnings of a business are stable, when they are not fluctuating, such companies are likely to predict its future earnings easily, and they are more likely to pay higher percentage of its profits as dividends. But a company who experiences a lot of fluctuations in its earnings will not be in a position to easily predict its future earnings and is more likely to pay lower percentage of its profits as dividends. Number two, financing policy of the company. Dividend policy is affected by the financing policy of the company. If the company has a policy of meeting its financial needs of the future through external sources, such companies will pay higher dividends. But if the policy of the company is to make use of internal source of funds, that is through retained earnings, then lower percentage of profits will be paid as dividends. If the financing policy of the company is skewed towards external sources, such companies generally pay out a higher percentage of dividends than a company whose financing policy mainly focuses on the internal sources of funds. Number three, dividend policy of the competitors. Another factor which influences the dividend policy of a business is the dividend policy of the competitors. If the competitors are paying higher rate of dividend than this company, the shareholders may prefer to invest their money in those businesses which are paying higher dividends. Number four, past dividend rates. If the firm is already an existing firm, it can look at what dividends have been paid in the past years. On the basis of dividends declared in the past, the firms can pay dividends accordingly in the coming years. So this will ensure that the firm has maintained stability in the dividend rate. It is always better for a business to maintain stability in the dividend. Number five, debt obligations. A firm which has incurred heavy debt obligations is not in a position to pay higher dividends to shareholders. Therefore, for such businesses, earning retention is very important because they have to reduce their debt obligations substantially. If the company has no debt, if it is free from debt obligations, such companies can afford to pay higher dividend to shareholders. Number six, ability to borrow. Every company requires funds for expansion and meeting its expenses, and for this purpose, the companies have to borrow from the capital market. Established and large firms which has a reputation in the market will have easy in tapping the finance from the capital market because of their reputation and goodwill, and they tend to pay higher dividend to shareholders. But new companies or the companies which are run on a small scale, they have difficulty in accessing the capital markets. Therefore, they pay lower rate of dividend. Number 7, the growth needs of the company. Another factor which influences the rate of dividend is the growth needs of the company. In case the company has already expanded considerably, it does not require funds for further expansion purposes. These companies can declare higher rate of dividend. If the companies has expansion programs in future, it needs more funds for growth and development purposes, and therefore they pay lower rate of dividend. Number 8, profit rate. Profit rate is one of the important factors influencing the dividend policy of a business. The rate of profit and the rate of dividend are directly related to each other. Higher the rate of profit, greater will be the rate of dividend, and vice versa. If the firm has profitable investment opportunities, such companies will pay a lower dividend to shareholders, and the companies which has no profitable avenues for investment, they tend to pay higher dividend to shareholders. Number 9, legal requirements. While designing a dividend policy, the companies have to consider the provisions of the Companies Act, Income Tax Act, and the SEBI guidelines. Under the Companies Act, dividends can be paid out of current profits or past profits after providing for depreciation. Further, the companies have to transfer a prescribed percentage of profit to general reserve if the rate of dividend exceeds certain percentage of paid up capital. For example, if dividend rate is less than 10% of paid up capital, such companies have to transfer 2.5% to general reserve. Similarly, if the dividend rate is more than 20%, then in such cases, a minimum of 10% of net profits should be transferred to general reserve. The Companies Act also says that dividends cannot be paid out of capital. So, when dividend policies are being formulated, it is the duty of the finance manager to look into the various legal provisions under Companies Act, Income Tax Act, and also he has to look into SEBI guidelines in this regard. Point number 10, policy of control. If the company feels that no new shareholder should enter the company, then such companies usually issue bonus shares to the existing equity shareholders instead of issuing equity shares to the general public. On the other hand, if the company has no objection in inviting the general public to subscribe for its shares, then the companies may go for fresh issue of equity to the general public and may pay a higher rate of dividend to shareholders. Number 11. Corporate tax rate. Corporate tax rate means the income tax payable by the corporates on the profits to the government. The corporate tax rate and the dividend rate are inversely related to each other. If the corporate tax rate is high, it reduces the profits available for distribution to shareholders, and hence the rate of dividend will be less. On the other hand, if the corporate tax rate is low, it increases the profits available for distribution and therefore the rate of dividend is more. A lower rate of corporate tax increases the profits available for distribution and thereby the companies have got a cushion to make a higher rate of dividend being paid to the shareholders. Number 12. Tax position of shareholders. The tax position of shareholders is another important factor which influences the dividend policy. If majority of the shareholders belong to high income group, they may not like to receive cash dividend, rather they may prefer capital gains instead of cash gains. 13. Effects of trade cycle. Trade cycles have strong influence on the dividend policy of a company. The dividend policy has to be adjusted according to the changing business conditions. During the boom period, management has to follow a conservative dividend policy and create good reserves to meet contingencies which may arise during inflationary period. During depression, a regular dividend policy has to be followed by the company as a tool for marketing its securities in the share market and prove its financial solvency, provided the company has maintained adequate reserves. 14. Attitude of interested group. A business may have a certain group of interested and powerful shareholders. These shareholders have certain attitude towards payment of dividend and have a definite say in the formulation of dividend policy. If they are not interested in higher rate of dividend, shareholders are not likely to get that. On the other hand, if they are interested in higher rate of dividend, they will manage to make the company declare higher rate of dividend even if the company is facing many odd situations. So these are some of the determinants of dividend policy of a company. That's all for today. In the next class, we shall discuss with few more aspects of dividend decisions. To begin with, let us understand the concept of dividend. A company has to make payment of various expenses out of its sales, revenue and other incomes. It has to incur variable cost, fixed cost, pay interest to debenture holders and pay interest to banks and financial institutions for taking loan, pay taxes on profits, and so on. After meeting all these payments, the surplus amount which is available with the company is known as distributable profits, or it is the divisible profits. This divisible profit is divided among the shareholders. The division happens on the basis of the shareholdings of the investors. So when the profit is distributed among the shareholders according to the proportion of their investments is known as dividend. So dividend is of profit which is distributed among the shareholders in accordance with the proportion of their investment in the company. Now, having learned the concept of dividend, let us understand what retained earnings is. So as I told in the previous concept, that dividend is a portion of profit which is divided among the shareholders according to the proportion of their investment. Retained earning is the portion of profit which is not distributed to shareholders, but it is the amount of profit which is retained, which is kept in the business for future growth and expansion. So retained earnings forms an internal source of financing for the business, and it is a cheaper source of finance because of two reasons. One, there is no flotation cost involved when you use retained earnings as a source of finance, and no legal formalities are required. Dividend payout ratio and retention ratio. Dividend payout ratio is the percentage of earnings which is distributed as dividends to shareholders, and retention ratio is the percentage of earnings which is retained in the business for future growth and expansion programs. Let us understand how dividend payout ratio and retention ratio is calculated. Suppose the total earnings available to equity shareholders after making all the payments is rupees 5 lakh, and there are 1 lakh equity shareholders in the company. So earning per share equals earnings available for equity shareholders divided by number of equity shareholders. Earnings available is rupees 5 lakh and number of equity shareholders are 1 lakh. So therefore, earning per share will be rupees 5. Suppose the board of directors have declared and sanctioned a dividend of 20%. 5 rupees is earning per share, and dividends declared and sanctioned at the annual general meeting is 20% of the earnings. So in this case, dividend payout ratio is 20% of net earnings. So 5 rupees is EPS. Out of 5 rupees, 20% will be paid as dividend per share. That is, dividend per share will be rupee 1. 20% of rupees 5, and 4 rupees is retained in the business, that is retention per share. So retention ratio will be the remaining percentage which is retained in the business. Therefore, retention per share will be rupees 4. Dividend payout ratio is the percentage of your earnings which is distributed to the shareholders as dividend. So each shareholder will get 20% of the EPS. So totally 20% of 5 lakh, that is 1 lakh, will be distributed in the form of dividend to all the shareholders. Similarly, 80% is the retention ratio, that is 80% of 5 lakh, that is 4 lakh, totally will be retained in the business in the form of retained earnings, that is from each share rupees 4 is the retention. So when the dividend payout ratio is more, retention will be less, and when dividend payout ratio is less, retention will be more. So dividend payout ratio and retention ratio, they move in opposite direction. They are inversely related. The percentage of the profits which are available for distribution, which is distributed among the shareholders as dividend, becomes your dividend payout ratio. Retention ratio is the percentage of the profits available for distribution which is kept in the business for future financing needs of a business, is retention ratio. As I told, dividend payout ratio and retention ratio are inversely related to each other and they move in opposite direction.